How you doing, folks? The Nasdaq June contract we're rolling out of that. So every time we talk about Nasdaq after this presentation here, it will be focusing on the September 2025 delivery contract month for NQ. And if I happen to talk about the ES or Dow, they would be also the September contract for 2025. All right, so we're looking at the daily chart for Nasdaq, and I want to talk a little bit about the keys to success trading troubled markets. Now, a troubled market is obviously what we're engaging right now. And before we get into it, obviously this weekend we just had a whole lot of stuff happened. I told you it's one for the history books. I told you we'd probably be seeing some exchanges between two countries, and it's been pretty fierce. So my heart goes out to both countries and the innocent people that are being affected by it. But there's no winners in wars, folks. It's unfortunate. There's loss on both sides. So we're looking at the 21st of February. That's SIBI, that down close candle here. And then we have this February 24th SIBI. And I have that graded. So it has the Fibonacci levels on it. And this is just simply highlighted. That was an upside target that we had, and you clearly see that we did, in fact, hit it. Now, what is a troubled market? Well, the way I define it, it's where the market just has a unwillingness to go higher or lower, and it starts sharing the previous candles or bars ranges. And that's what we're seeing here. Okay, look at basically all of this price action on this wick. Dropped down, then rallied up, came back in, consequent encroachment of this candlestick's discount wick, rallied up back inside of the 24th of February's SIBI and traded up into 21st daily SIBI, broke back down back into a fair value gap on the daily chart that's formed on the 3rd of June 2025, and we opened right at the low of that. You see that? And came right back up to consequent encroachment of the SIBI of February 24th, 2025. And that's, again, this single sell-side imbalance, buy-side inefficiency. Now, some of you may be looking at this and saying, why are you making such a big deal about that? Well, if you recall, I was giving guidance on NASDAQ that we would be bullish, looking for prices to reach up into this gap when we were down here. And it rallied up, came back down in. I said this would be an ideal scenario if it went below that low institutional order flow entry drill, which is what we're seeing here. Then it rallied up and used this down close candle as an order block. It just kept driving up into this inefficiency with the extreme running up into this gap there. But it failed to get the consequent encroachment on that. Notice that? Long term, without trying to pick a top, I'm using these highs here as a relative equal high draw on liquidity daily chart. So I'm not trying to pick a top. I'm still focusing on the likelihood that it could continuously grind higher, even though it is difficult to position longer term and put a reasonable stop loss in there without taking exorbitant risk. And the gap risk is such enormous concern right now because of all the things that's going on over in the Middle East and domestically here in the United States. So there's a lot of stuff going on. I'm not going to belabor the topics and rehash and recover all that stuff I mentioned in posts on Twitter, or X they call it now, on any space I did over there. So we're going to focus on these quadrant levels and ignore, now here's the thing, we clearly would agree that this swing low is obvious. Okay, so that right there, and I'm going to make that large and maximize its width. Okay, and this high right there. So there are two significant pools of liquidity: near-term buy side, near-term sell side. Now, there are minor buy side liquidity pools, for instance, the one we have here on June 6th and 13th of June, which we didn't breach that so far this week. We opened at the low of the fair value gap there, which is probably random, trading up into consequent encroachment of that gap right here. Okay. So, for the sake of keeping track of it, I'm going to show you that range and highlight it in something like, let's use a very, very light green. That way you'll know what I'm referring to based on the daily chart and these levels here, okay? So all these levels are quadrants. This is the low, the lowest quadrant, consequent encroachment, midpoint, upper quadrant, and the high of this individual fair value gap, which is a CIVI. We did the damage of running up into this gap there, but failed to get to consequent encroachment. So that means it could, I'm not saying it will, I'm not saying that it is, but it could have topped on a short term. And then might we see the run into the sell side here, that low, and then under here, and maybe so much as a return back down in here and fix some of this inefficiency in this buy side balance, sell side inefficiency, while leaving this high intact. It's on the table, but I'm not pressing it hard. In other words, I'm not trying to sell the idea to you as a viewer or a student that's tape reading with me, because this is not trade advice for you folks. Okay. You know, despite the accuracy of what you see me sharing and calling for an analysis, do not use what I'm talking about here as trade advice. Okay. Obviously, it's meant to inspire you to watch price action, to get encouraged by the topics and subject matter that I teach on this channel and on my X channel. But just remember, the risks are exorbitant right now. Huge, huge, off the charts level type of risk. So just be mindful of that. So now that we have all this lipstick on the chart, I'm going to drop down into a 1 minute chart. Okay. And this morning, I was watching the consequent encroachment level of, actually, I just realized I didn't. Let's go back into the daily chart. I got to highlight this and make sure it shows up in the lower time frames. All right, so let's transport ourselves right back down into the 1 minute chart. Get the monthly. Out of shape here, ICT. Got to get back into the rhythm. All right, so we have the consequent encroachment level of that February 24th daily CIVI, and that's the upper quadrant, and then it's the high. See how we're working in the lower half? So in the lower half, and you're going to hear my puppy snoring, Miss Piper over there. I'm in such a holly jolly mood. I'm watching this while we're doing this video. The which is going to be useless to you, but it's just one of those things. I'm like a dog looking at squirrels. Squirrel. So it runs up into it several times, leaves these relative equal highs. It punches through it, breaks down, doesn't take out the swing low. Notice that it comes back down into, which you'll see when we get into a lower, even lower time frame on the 30-second chart. There's a volume imbalance right in here. Then it rallies up once more, leaves the high intact, gives a fake bull flag. Okay, because bull flags, you know, are nice little retail traps when you incorporate them with an algorithmic price level, like the consequent encroachment level of that February 24th, 2025, which I have been beating to death for weeks for you to watch. Study it. When you're using analysis concepts from the retail collection, you're going to get a lot of frustration right now because the market is being very fickle, meaning that it's allowing for sentiment to build up because there's a lot of things going on around the world. And the next move that we see is probably going to be very significant, whether it be up or down, it's going to be significant. And the longer they keep the market in this, just, it's not necessarily a range bound market, but it's staying inside of a chaotic portion of price action. So the way I define that is it's time distortion. Okay, so they're holding the market in a holding pattern to afford traders time to build a bias, build a narrative around what they think the market's going to do, because there's a lot of risk right now, and large money isn't just dogpiling in and pouring money into it. So they're going to let the market stay inside this chaotic price consolidation, and then boom, once they rip it out of it, higher or lower, that will encourage large, deeper pockets to participate. Right now, they're not participating. So to be a trader in this environment, you have to be very, very nimble. Okay, so the keys to success in a troubled market is stop thinking classic support resistance. Okay, stop doing that. I'm not a proponent of it anyway, but in these environments, you have to think differently and you got to think outside the box. So by having a old array, like I've mentioned, February 24th of 2025, there's no denying the fact that I've keyed your attention up to that very individual day. And the context, you have to go through all the videos since I first mentioned it, a couple months ago. So you can track the narrative as to how I used it. And now I'm going to give you a little bit better insight with it today. When you have a range like that, where you can see the consequent encroachment levels, this blue level here, and we're having a difficult time getting above the midpoint up in the upper half. So if a market's bearish, you're going to see signatures like that. And then if it's going to be bearish and it's reacting off the consequent encroachment level, where could it trade down to the next level, which is the lower quadrant level? Well, because the market's fickle and it's being held in a range where buys and shorts are struggling to find the courage to hold on to them. When the market finally does break below this swing low and this swing low right there, that's a shift in market structure. So now anything in here can be used as it's a premium array to get short. And then aiming for low hanging fruit objectives, which would be something like this low, that gap right there, that's an actual gap or liquidity void. That low here, that low, or if you have the brass to hold for it, the lower quadrant level. And you can see it only gave you one opportunity right there. And then it comes back up, fails to go lower, rejection block, lowest down close price, rallies up, buy side imbalance, sell side inefficiency, add the volume imbalance there, trades down into it here, rallies up, retracing back down into the gap in here. It's volume imbalance, trades down to it, consequent encroachment of that volume imbalance, then rallies up, small little gap here, trades to the high, leaves this high intact here, drops. What's that? Minor buy side, drops back down in, this gap, complete closure, rallies once more, bullish fair value gap, trades to it there, extrapolated run to the upside, minor buy side taken, rallies up and just falls short of the consequent encroachment level of that February 24th, 2025's daily SIBI. In here, when the market broke structure here, there's a volume imbalance. When we drop into the 30-second chart, right there, and it's that low also. So when the market broke lower, a premium array would be in here. Now, premium relative to what, Michael? That level down here. So let's look at it this way, because there's a lot of people that think they understand my theory of discount and premium. They don't really, but this break in structure, soon as that break in structure occurs, right here, or this one, if you're looking at the 1-minute chart, this break in structure right there, if you anchor it to that low, down to that level right there, anything at this level or higher is a premium. For me, the way I use that is if there is a setup that I can be getting short in, can I afford myself at least 15 handles in the NASDAQ? If I can't get comfortably 15 handles out of it with spread considered on both sides, then I'm not going to take the trade. So you can see that in here, it affords you, if you're up here, trading around the 70s, or if we're going to be conservative, the 67s to the 52s, in that range, that can afford you a opportunity to get 20 handles or net 15 with the slippage and spread and or the commission costs per contract. On the 1-minute chart, inside this area also was a inversion fair value gap here, right there, and then the liquidity below there being taken, but after failing to operate as a retail bull flag with the level I've been telling you to watch, which is consequent encroachment of February 24th daily city. And this inefficiency here, any retracement up in, we want to see it stay below the halfway point. So your stop loss would be anywhere in here or one tick or two above the midpoint, because we want to see it rotate lower and it rallies up, trades into it there, and then breaks lower. Now I have PD arrays, and I know that you guys are going to go all juiced up about this, but I have PD arrays that afford me very precise things, but I'm not going to teach them to you. But some of you ask a lot of times, like, how do you trust putting your stop loss at that level where it's just one tick away and it'll trade right back to it just by one tick and fail to hit the stop loss and then run away? You've seen hundreds and hundreds of examples of me doing that, both in Forex and also in futures contracts. So one of the things that allows me to do that is this is a PD array that I'm not going to teach you, but it is unfortunately one of those best kept secret type things. This is the range that I'm grading, and it's this candle's high and this candle's low. The lower quadrant, if I'm bearish, I want to see it stay below the midpoint of that at 1 minute imbalance, or sell side imbalance, buy side efficiency. In the 30-second chart, and this is not to teach you anything, I'm just answering a question, but causing more questions to come up, which is going to frustrate some of you. But as I said many times, there's a lot of things I'm guarding. I will never teach it. You can put a gun to my head. I'm never going to teach it to you. It's not going to happen. It's for my family members. It's for my children. And now, hello, I'm going to be a grandfather. Cody and his wife informed me yesterday for Father's Day that I'm going to be a pop-pop. So I'm so excited. I can't believe it. It's like the day's finally here. My wife and I are ecstatic. So I kind of felt something was coming. Like I just knew something really was brewing. And when they came over here, he gave me a gift with his 3D printer. And as I picked it up, it was rattling. There was something in the back of it. And it was just like a little 3D printed thing. Guess who's coming? And the daughter's name or son's name was shared on it. And I'm not going to give that information out. It's too private. But the point is, these types of things I guard. And it's not meant, it's too good for the public. It's absolutely too good for the public. I would never put a price tag on it and teach it, and I would never share it with anybody outside my family. But like I said, I have 81 of these things. But if you look at the retracement up in, look at the high of that candlestick right there on the 30-second chart. That's supposed to be noise, Goldman. It is 21,777.00. That's the high. And that's also the lower quadrant level right there to the tick, 21,777.00. So my stop loss can be 1 to 2 ticks above that. And that's how I'm doing a lot of the things that you see me do. Stop loss placement management, like to that degree where I'm doing it, where it's Olympic level. I'm never gonna teach that to any of my students. That's this too good. It's not necessary. And I've already taught how to manage a position with a proper stop loss that's reasonable. Now, quickly, you can use these ideas, if it's something you understand, but you're never going to understand because I'm not going to teach it to you. And I know this is going to really piss people off and it's going to make them mad. But I've already warned you that there's some things that I'm not going to share. I'm not going to teach it to you. Okay. I'm not going to. But to be fair to the individuals that genuinely have a concern for how I place my stop losses and manage them so ultra tight, it's these types of things behind the scenes that I'm never going to articulate or make available because my stuff has already been adulterated to the degree where it's absolutely being abused by people that don't know how to trade with it and are selling mentorships and adding to it saying that this is stuff that he's hiding. He didn't teach this in his YouTube channel, but it's really in the secret parts of his paid membership and all that stuff. That's all bullshit. Okay, I promise you that's bullshit. They're just trying to rook you to get money from you. These types of things that I'm showing you here, and many more of them, this ain't even all. This is nothing. Like this is absolutely nothing. But when I'm managing a stop loss, this is one type of PD array that I use. Even though you think you might see it, might be figuring it out, and you're going to come out and have your own little interpretation of this, you're going to be wrong. I promise you. And if you don't believe me, have them trade with it in something like a live account like that. So the the reason why I cover that stuff up, folks, is because I'm not trying to push you into a brokerage firm. I'm not selling the attention to a specific broker. I don't get any relationship kickbacks from them. Okay, but that's why I don't show it. And frankly, it's none of your fucking business who I trade with. That's the reality of it all. Okay, so to keep things germane and to price action only, when I show my examples, when I show my executions, when I show my management or analysis, and you see these things down here covered up, it's number one, it's for decency, it's for privacy, and two, it's none of your damn business. Okay. If you want to trade with the brokerage firm that I'm trading with, you've made that decision on your own. Okay. You're not going to get me telling you and twisting your arm, you better go with this broker because they're better than everybody else. Every broker sucks. Every single broker sucks. So there you go. I'm not with anybody. I don't have any affiliate programs, period. But with all that stuff out of the way, and now explaining, why sometimes my stop losses are ultra precise, that I felt comfortable that by entering inside of the volume imbalance here, which is right there, which is also factoring in that low, the drawdown should be limited to worst case scenario, consequent encroachment of that 1 minute SIBI that's in this shaded area here. But trimming that back down to a 30-second chart, that retracement up in here to the lower quadrant, 2 ticks above that, which is usually about what I have. If I have a level I have in mind that I want to see it not breach, then I'm usually going 2 ticks above whatever that level is or below if I'm long. So the factor of that 1 minute SIBI, now let's go back to the 1 minute chart. Again, monthly. 1 minute chart. This sell side imbalance, buy side inefficiency. It's that one single down close candle right there, framing it by this candle's high, that candle's low. So entering here, the retracement up in here. I wanted to add 2 more contracts, but it didn't give me a chance. I mean, these are 30-second fluctuations on very small time frames. Even though the 1 minute looks like it's hanging out there for a long, long time, it's not there very long. So the time I'm watching it and my brain to say, okay, I'll take it there, and then the reaction time that's required to do it, it's kind of like driving a car or a tractor trailer. Uh, well, between the two, the reaction time and stopping time by you seeing something as a hazard in front of you driving your car with 4 wheels is quicker versus someone that's driving a tractor trailer. They may see the same hazard too, but the reaction time of them putting their foot to the brake and then the brakes being applied and then slowing that vehicle down is a stark contrast between the two. Well, when you're using these very ultra short time frames, your reaction time is going to be very, very skewed. And limit orders are ideal, but this morning I was measuring volatility, and I was also measuring the order flow and liquidity of the June contract because I wanted to see early on if I was going to use June for New York session, AM or PM session if I do any trading in it, or if I was going to roll over today for the September contract. And I already posted on X that I'm going to be trading with the September contract going forward. So this is the last time we look at this particular contract.